I think one of the reasons why we did a reasonably good job of protecting capital during this turbulent period is what we've been calling for, which was, if you heard one of our SkyBridge presentations, you know that there were three things worrying us: market liquidity, the ETFs, and some of the ways these ETFs are priced. It's a very crowded trade, and some of these ETFs have relatively illiquid bonds priced into them, like the high yield ETF. So we're worried about that as well. And then the third thing that we're worried about is the late cycle deficit spending by the U.S. government, which would just give the government less maneuverability. So for those reasons, we were in a defensive position. But now as markets have weakened, we'll start to grade into the markets over the next 3 or 4 months. We sort of think that there's probably another 10 or 15% drop here potentially. But one thing we know for sure is that markets will correct more quickly than the economy. And so we want to make sure that we're putting on more risk, taking on more equity exposure going into that period. The main cause of the volatility that we've seen in the ETF this week is just a general lack of liquidity in the overall marketplace. And so one of the things we've been saying consistently is that the Volcker rule literally took the commercial banks and the investment banks out of the balance sheet investing process. And so we used to have very large scale proprietary trading desks all over Wall Street. SkyBridge estimates that there's about $450 billion of balance sheet capital that's been removed from the marketplace as a result of the Volcker rule, which has helped the banks be stable. There's no systemic banking risk here in this crisis, but it's had the deleterious side effect of there being an absence of liquidity when markets get very uncertain. And so the sloppiness that you're seeing in those ETFs right now are electronic traders, these algorithmic traders. When they see huge volume, they just automatically and robotically price things down 5 or 10%. So we're super worried about some of these bond ETFs because, again, a lot of these securities are priced monthly, particularly in the high yield ETF, but yet they're required to have daily liquidity to meet the ETF criteria. And so for this reason, there's a mismatch between the asset and liability, and that's what's causing so much market uncertainty and volatility in that space. We think it's more or less certain that we are going to go into a recession. Likely second quarter GDP numbers are probably -5%. The third quarter will probably also be negative growth. And so that obviously meets the definition of a recession: 2 successive quarters of negative growth. But I'm not a big believer that we're in a V-shaped recession. I don't think we recover that quickly. This will have a U to it. It'll come down for a period of time, flatten out for a while as businesses are recalibrating. The government figures out what kind of policy initiatives they're going to put in place, fiscal initiatives, in addition to what the Fed is doing. And so for those reasons, we're not 100% sure what will happen to things like the hospitality industry, the travel and entertainment industries. But without a government stimulus or some kind of government backstop, the recession could last longer and perhaps be deeper than people think right now. The money market space and the yield curve are worrisome to us for several reasons. The first reason is the interest rates are incredibly low, which supports asset prices, but unfortunately puts a tremendous amount of stress on middle class and lower middle class people. The very good news for America, the American economy, is that the American consumer is arguably in its best position that it's been in at least a decade. And so savings rates have been up since the financial crisis, and the balance sheet of the American consumer has been up. But because rates are so low, many people are not in the stock market. As we know, probably the top 10% of the wealth in the country is controlling 84% of the stock market. So there's a very, very large group of people that are not participating in the market's growth and the market's rally. And so these low interest rates are having a really bad effect on them. The flip side of that, though, is that when they're borrowing on things like mortgages, it's easier for them to make their monthly payments. So net for SkyBridge, we've been very well positioned by putting most of our bets over the last 2 years on the American consumer as it relates to mortgages and structured loans and making investments in the community banking preferred debt space. So all of those things are relatively good news for SkyBridge and the SkyBridge investor, but long term, we're going to need a steeper yield curve Typically, a steeple yield curve implies that there's growth in the economy. And right now, if you factor in inflation, we probably have negative interest rates in the U.S. So that is worrisome. We have to think of this as a wartime environment, very similar to our grandparents and great-grandparents and what they had to do in the war in terms of abiding by curfews and relative rations and things like that. So hopefully we'll have the will, we'll be slightly less selfish as a group of people, and we'll realize that we're stronger together if we can move in a horde here to slow down the exponential possibilities of the pandemic.
All investments are subject to risk, including the possible loss of the money you invest. For more information about SkyBridge Multi-Advisor Hedge Fund Portfolios Series G and the SkyBridge G2 Fund, call 1-888-759-2730 to obtain a prospectus. Investment objectives, risks, charges, expenses, and other important information about a fund are contained in the prospectus. Read and consider it carefully before investing. This webcast is for educational purposes only. We recommend that you consult a professional advisor about your individual situation.